In this scenario, we're going to continue or pick up where we left off. So we're going to have the same exact scenario as we had before, but instead of a credit sale, it's going to be a cash sale. And of course, if there's a cash sale, there's no discount, right? Because you're going to just pay whatever the amount is. You give a discount because the person is paying on credit. So the first two transactions are the same exact. So the transactions on the first are the same exact ones on the sale with no credit taken, and there's the same exact transactions on the first scenario, the sale on credit with discount taken. So you can look at the previous videos for that. So these two transactions don't change. Where ABC purchased inventory, so we debit inventory for 2,000, we credit cash for 2,000, we debit inventory for 1,000, we credit accounts payable for 1,000. So now we get to the fifth, right? So ABC sells 5 widgets to XYZ company for $150. Okay. And again, this is a cash sale. So what's going to happen to ABC, right? You can remember this. So ABC now is going to have the items move from inventory to cost of goods sold at cost, right? Because the items are sitting in inventory. It's going to go to cost of goods sold. Doesn't matter if it's being paid with cash or not. That's what's going to happen. So we're going to debit cost of goods sold for 500, credit inventory for 500. How do we get 500? Again, it's 5 widgets, $100 per widget. 5 times 100 is 500. So we're going to debit cost of goods sold and credit inventory for 500. Now, we sold these items for $150 each. So 150 times 5 is 750. So XYZ is going to pay us cash of 750. All right, that's how much XYZ is going to pay us. And then what is going to be our credit? Okay, our credit is going to be sales revenue because we earn revenue. So we're going to credit sales revenue for 750 and debit cash for 750 for this transaction, right? So again, whenever the seller has a sale, you have two parts of the entry. One is the cost part, where we move the items from inventory to cost of goods sold by crediting inventory and debiting cost of goods sold, and this is always at cost. And then you have the sales part, which is at the selling price. So we credit sales revenue for the items we sold and we debit cash. If this was on credit, you would debit accounts receivable. And so what's going to happen here to the buyer? Well, the buyer is going to pay, right, $750. And then what do you think the debit is? When XYZ buys this, where is it going to go? It's going to go into its inventory because XYZ is going to sell it later, right? So we can journalize these now, okay, in this transaction. This is the third scenario transaction. I already have the first two entries in here, the $2,000, the $1,000, the 1,000 in accounts payable, right? So that's already in there. And so now we just have to journalize this. The cost of goods sold for 500 in inventory. So I'm going to put 500 for cost of goods sold here. Inventory goes down by 500. So now we got 2,500 left and 500 in cost of goods sold. My cash is going to go up by 750. So I'm going to debit cash for 750, right? And then what's the other side of my entry? My sales revenue is going to go up for 750. Okay. Now on this side, I have I'm going to pay cash of 750. So my cash is going to go down, and then my inventory is going to go up by 750, and that's it. Okay. Now, the other thing is that this was FOB shipping point. So FOB shipping point on this transaction, who pays the shipping charge? You remember FOB shipping point? The buyer pays the shipping charges and it's part of inventory, right? So when we come down, there's going to be no entry here for the seller as it's FOB shipping point. And then we're going to debit what? Inventory for the shipping costs, right? Whenever it's the buyer paying the shipping costs, you're going to debit inventory. When it's the seller, you're going to debit shipping expense. So we're going to debit inventory for 50 and credit cash for 50. So here's my inventory for 50, my cash, here's my credit to cash, oops, for 50, and that's it. So I don't have any adjustments to accounts payable and accounts receivable. I don't have anything like that because everything was done in cash. So it's a lot easier, right? When you pay from a journal entry standpoint, when your customer pays in cash and there is no credit extended. But most companies are not able to pay in cash, and so you extend credit because it increases your sales. All right. So that is this transaction. So we went through three scenarios, right? We had sale on credit with discount taken. So we did that. We went through that. That's a whole bunch of videos there. Then we went to sale on credit with no discount taken. Okay. And this was a cash sale. So it's no sale on credit. You sold the items and you got paid cash right away.